Good day and welcome to this live webinar brought to you by Sanlam Investments. My name is Gili de Swart and I head up the retail distribution function at the business, and I will be your host during the session today. But before we kick off the session, allow me to take you through some of our house rules. Firstly, you can sit back and relax. We are recording the session and we will provide you with access to both the recording as well as the presentation afterwards. As per normal, we've also applied for CPD points via the FPI. We are awaiting the outcome of these potential allocations, and we will share with you the process on how to claim these potential points afterwards. However, keep in mind, you need to stay online for the full duration of the session to qualify for any potential points. And then lastly, please let's keep it interactive. Please utilize the Q&A functionality at the bottom of the screen to post any questions you want to ask me or the presenter afterwards. Our presenter today is Kingsley Williams. He's the Chief Investment Officer at Satrix. Kingsley is going to take you through the quarterly feedback on the balance funds for the third quarter of this year. Kingsley, welcome. I know you've got a very full agenda. I'm not going to waste a lot of time. I'm going to hand over to you, and then we will engage during the Q&A session afterwards.
Brilliant. Thanks, Gili. Trust I'm coming through and that you can see my presentation.
Perfect. Thank you, Kingsley. You can continue.
Great. Good to be speaking to you all this morning, and thank you very much for joining. As you can probably tell, I am back at the office. So it's good to be at the Tyger Valley office here in Bellville again, enjoying a coffee from our cafeteria, which is something I haven't had in a while. But it's also been a while since I've spoken to you about our balanced funds and provided an update. So yeah, let's quickly dive into that. In terms of an agenda, I'm just going to give you a quick update on how the business is doing, and then we'll get into what has been transpiring in our market, how our funds have been doing relative to the industry more broadly, and the specific styles and features of our funds which separate them from other peers that you might be considering or wanting to get an update on. So very quickly, where Satrix is as a business, we've crossed the 150 billion in AUM mark. That's a significant milestone for us as a business. In fact, one has to pinch oneself every now and then. It wasn't even 2 years ago that one of our long-standing portfolio managers who'd been involved in the business since the start of Satrix back in 2000 retired. That was at the end of 2019. And at that point, we just crossed over the 100 billion mark. So for us to now be at 150 billion in less than 2 years is a phenomenal achievement. And we really want to thank you as our clients for your support in helping us achieve this milestone. The growth of our business is largely, a reflection of clients increasingly adopting indexation strategies into their portfolio. But we couldn't be at this level without your support and the confidence you've placed in us. So thank you very much for that. This is just showing you what that AUM growth has been through time. And you can see specifically today, we're going to be focusing on the multi-asset solutions or balanced funds shown in red, which have also grown phenomenally, particularly over the last few years. But pleasing to see healthy growth across the board. And I think one of the things which really separates Satrix from many of the other index investment managers operating in our market is the fact that we're able to offer all vehicle types as well as a very wide range of investment strategies within those vehicle types. So not only are we the leader within the ETF space, we also offer unit trust, which is what our balanced funds, the vehicle our balanced funds operate within. We've got offshore vehicles, and then a large book of segregated and life pooled funds that we manage for clients as well. So within all of these different vehicle types, whichever vehicle type suits you most and is most convenient for you to use, there are a variety of different investment strategies available as well. And one final business update slide before I get into the bulk of the presentation, the core of the presentation, is just a breakdown of who our clients are. And you'll see here in the light blue and the red, these are largely retail-based clients, either intermediated or direct through primarily through our Satrix Now platform. But then a significant portion of our book is actually institutional clients. So those could be pension funds or indeed other CIS funds, which have appointed us to manage a portion of their portfolios for them. But we really want to just acknowledge your support as intermediaries, supporting clients and supporting Satrix as a business to invest into our funds. We really once again want to thank you for your ongoing support of our business. It's greatly appreciated. So let's move into the next part of the presentation, which is really the core of the philosophy behind our indexed balance funds. And to understand that core, we need to look at what the primary drivers of returns are, particularly over the longer term. So this really forms an anchor for the rest of the presentation that I'm going to take you through. And it's important to recognize that 90% of portfolio variance and therefore performance comes from broad market exposures and exposures to strategic factors through time. So by broad market exposures, I mean strategic asset allocation to the broad asset classes. And by strategic factor exposures, I'm specifically referring to your style of investing primarily within equities. If you think about it, equities are your most volatile asset class. So when we talk about 90% of portfolio variance and volatility coming from these factors, it's important to know that your style of investing within equities, which is your most volatile asset class, is going to play a significant role in the long-term return. And by style, I mean whether you adopt a value or a growth or a quality philosophy in the way that your equities are managed. And this would be quite typical when engaging with an active manager. You'd want to understand what their investment philosophy and style is in the way that they approach their investments. So it's quite so that doesn't mean that these are the only sources of return. There are obviously other sources of return as well. If we rewind a few decades, it was thought that the primary source of returns came from stock picking and which securities you had in your portfolio. But as research has progressed, clients and the industry at large now appreciates that the bulk of your returns are going to come from your strategic asset allocation and what your predominant style is in your investment process. It's another contribution, but again, a very minor source would come from timing the markets. And this could be either within equities or within factors, or indeed doing tactical asset allocation. But important to note that this is a minor source of returns relative to the bulk of where returns come from in the long term. And this is really what underpins our philosophy and the way in which we've constructed our index balance funds. In fact, there was an article recently published in the Journal of Index Investing, where the authors show that tactical asset allocation mutual funds significantly underperform equivalent index exchange traded funds tracking the same investment styles and underlying asset exposures. And they also found that controlling for academic factors in construction methodologies, like we do in our local equity portion, which I'll take you through later, improves investment outcomes further. So at the core of what we do, we like to be able to control and have more predictable outcomes within each component of our portfolio. And this ultimately leads to more certain outcomes overall. So by tracking indices within each of the asset classes here, and also by making sure we have persistent and strategic exposure to primary factors which drive long-term performance in our equity market, we are able to have a more predictable outcome and deliver that to you as clients investing in our funds. If I can put it differently, indexing helps to keep the very active process of investment management focused on the primary drivers of portfolio performance, with greater certainty in the overall outcome. So now that I've provided that philosophical background and context to how we construct our funds, let's move into what asset classes have done up to the end of September and how these have informed how we ultimately construct our portfolio. So I'm showing you on this chart year to date in dark blue and in light blue the 1-year performance of various asset classes, including what our currency has done. So just to explain how the currency should be interpreted, if you see a negative return here, this means the dollar has weakened. which means the rand has strengthened versus the dollar. So over a 1 year period, the rand is stronger versus the dollar, but on a year-to-date basis, the rand is weaker versus the dollar. So bear that in mind. You'll also see the returns for the international asset classes. These are also quoted in rand terms, so I've applied the currency effect to those international asset class returns as well. And then the dotted line coming up from CPI is just to make it easier for you to see whether these asset classes have delivered a real return, in other words, in excess of inflation over the given period. So I'll show you an updated dotted line as we go through the different periods. So over the short term, 1 year and year to date, local risk assets, which are equities and listed property, over the last year have been incredibly strong performers, delivering in excess of 30%, with listed property being the standout performer at 54% over a 1 year period. This after lagging CPI and inflation and other asset classes for some time, it's pleasing to see some strong performance coming from inflation-linked bonds, and you'll see that with this index over here, which has actually outperformed nominal bonds for the first time in quite a while. And this is obviously off the back of increased inflation expectations. The strengthening rand against the dollar over the last year has obviously dampened the returns which we see coming from offshore markets in rand terms. Now, over the medium term, so this would be over a 3 and a 5 year period, local listed property is obviously still the notable laggard, but reversion to the mean is taking place with the strong returns we've had from this asset class over the last year. Offshore has been the primary driver of returns over this 3 and 5 year period, with our local equity market barely delivering a real return after inflation. And you can see that with the dotted line here, particularly looking at Cap Swiss over a 5 year period, only marginal real returns in excess of inflation. And we're well aware of the struggles our market has had over that period of time. Now, over the longer term, 10 years and longer, double-digit or near double-digit returns are the order of the day, particularly for growth assets, despite the lackluster returns from our local market over the last few years. And this provides significant real returns in excess of inflation. More defensive asset classes such as bonds and cash do have lower real returns, and this would be consistent with their risk-return trade-off. And this continues to confirm the long-term nature of investing in riskier asset classes and why it is important to stay the course despite the volatility and lackluster return we've seen from our local market in more recent years. You'll also notice that I've shown the performance of our Smart Core Index at the top of this chart, which you'll see outperforming our local equity market over all periods. So our local equity market as measured by Cap Swiss. And I'll cover this in more detail later on in the presentation. Now, it's very important when diversifying across asset classes to make sure they do indeed provide diversification, which is what this table summarizes with the correlations between asset classes since February 2002. Now, you'll see global asset classes, again, in rand terms, are mostly negatively correlated or uncorrelated, especially with local interest-bearing asset classes. So you'll see that in this block over here. If you look at our nominal bonds, inflation-linked bonds, and our cash returns versus all of these international benchmarks, you'll see all of these are negatively or very lowly correlated between them. And even if you look at our local equity market, it is negatively correlated with global, with global bonds. And this obviously largely speaks to the negative correlation that comes through from our currency and the effect that our currency plays on those offshore returns in rand terms. So this speaks to the importance of including different return drivers into a balanced portfolio and making sure they are optimally combined. If we take the average correlation of each of these asset classes with every other asset class, and then we plot that on a rolling 12-month or 36-month basis, we actually start to get interesting insights into the diversification benefits that different asset classes offer versus only diversifying, for example, within local equities. So imagine you've got a time series return. Just visualize it. I'm not going to show you that. But imagine you've got this time series correlation plot of what those correlations are through time on a rolling 12 or 36-month basis. And then if we were to turn that plot 90 degrees, so we're looking down the axis, and then plot how frequently those correlations occur at each level, we'll get the following chart. So this one, which looks like a nose on the left here, is what our local equity market has done, and the frequency of those correlations at different levels through time over a long period of time. In fact, this is over a sort of a 10-year period. And you'll see that the median average correlation between all equities in our local equity market on an unweighted basis is roughly at about 0.22 average correlation. But you'll also notice that there are periods where they are significantly higher correlated with each other. And this would typically occur in times of distress when assets have a tendency to decline or move sharply down together. Now, if we compare that to the same distribution plot of multiple asset class indices, again on an unweighted basis, you'll see that the median average correlation is close to zero at about 0.05, with the maximum average correlation less than 0.3. So this just shows that diversifying amongst different asset classes offers a much more diversification potential than diversifying amongst local equities alone. There's a lot more return drivers that you have, at your disposal when you expand the investment universe and you consider other asset classes rather than focusing your investments on local equities alone. But now, obviously, in reality, we can't invest on an unweighted basis. We need to factor in the size of companies and the liquidity of companies, or in the context of a multi-asset portfolio, we need to factor in Regulation 28 and the constraints that that imposes on how your portfolio can look. So these are now weighted correlations. So factoring in, for example, the correlations using the all-Z weights for local equities, and factoring in Regulation 28 a constraint portfolio, such as the strategic asset allocations we use in our Satrix Balanced Index Fund. But you'll see, even in a constrained context, you still get much better diversification characteristics coming through in a multi-asset portfolio relative to a local equity only portfolio. And this is important for investors who want more stable returns or are concerned about the risk of being exposed to equities alone. Obviously, within retirement savings vehicles like retirement annuities, pension funds, or provident funds, they have to comply with Regulation 28 requirements. And this obviously ensures a more stable outcome than investing in equities alone. And in fact, speaking of saving for retirement, there is now an option to open an RA on the Satrix Now platform for investors seeking to harness the tax-deductible and tax-free growth benefits of saving for retirement through this investment wrapper. So that's just a note for you that is available on the Satrix Now platform. So looking at how we combine all of this, we consider the risk, the correlation. So by risk, I mean the volatility of different asset classes, the correlation between them, which is what I've just shown you, as well as various return scenarios when determining our strategic asset allocation. And I'm showing you what the strategic asset allocation is for our Satrix Balanced Index Fund, as well as the Low Equity Balanced Index Fund. Now, we review this asset allocation on a biannual basis, in other words, once every 2 years, to take account of changes in Regulation 28, as well as ensuring, and this is very important, ensuring that our strategic asset allocation and choice of benchmark for each asset class is optimal. Now, this is where Satrix has a distinct advantage, in my opinion, due to our ability to work collaboratively across the Sanlam Investments Group and to have the input and expertise from various investment specialists in arriving at and verifying expected returns for each asset class, and combining this with the risk and correlation attributes of these asset classes. This is a disciplined and highly thorough process. It takes a lot of effort from all the parties involved, which enables us to position our funds correctly for the long term. And importantly, this is what you get when you invest in our funds. You don't just get this asset allocation as it exists now, but this will adjust and evolve through time to ensure that it is optimally positioned for the long term. Our last review of the strategic asset allocation occurred last year in 2020 and was implemented in our September index rebalance of that year. where the big decision to keep our allocation to local listed property unchanged has obviously been handsomely rewarded, as I've showed you with the returns over the last year for local listed property. Other changes included trimming domestic equity exposure and increasing offshore, as well as upweighting local interest-bearing asset classes due to the attractive real returns that they offer. The other change we've recently made is to standardize the domestic equity strategy across our two balanced index fund unit trusts. So since June this year, the Satrix Low Equity Balanced Index Fund now also tracks the Satrix Smart Core Index, and you'll see that over here. Previously, we tracked CAPSWIX to get broad market exposure as a broad market benchmark, but we've now standardized this to mirror our Satrix Balanced Index Fund to also track our Smart Core Index. So these two funds are now completely identical in terms of the indices they track to deliver their return outcome. The only thing which differs is the asset allocation. Excuse me for a moment. All right, so let's have a look at some trends unfolding within the multi-asset space and how our funds stack up relative to that investment landscape and those investment categories. So what this chart shows is the growth of the high equity multi-asset category through time. And you can see that the growth in this category has been phenomenal. You know, if we go back to December 2010, we were sitting at well below 100, well below 100 billion in terms of AUM in this category, and that's now rocketed to in excess of 600 billion. So there's been phenomenal growth in this high equity space as investors have adopted Regulation 28 portfolios as a primary means of saving for retirement rather than constructing them themselves, in order to have the ease and the benefits of letting the asset manager deal with all the regulatory compliance associated with the Reg 28 compliant portfolio. But let's have a look into this category overall, because what I've done is I've split the category into the largest 10 actively managed funds in light blue, the rules-based or index balance funds, of which ours forms a part in gold or yellow, and then the rest of the funds in purple. And what is interesting is the decline in share of the overall category of the largest 10 active funds. You know, if we go back to this point in 2010, they were about 85% of the category to just less than 70% now as at the end of September. And if we compare that to the gain in share of the rules-based index balance funds, which have gone from basically 0 up to about 7%. So there's been a 15% decline in the largest 10 actively managed balance funds and a 7% gain in share of the category overall of the rules-based or index balance funds. So what this means is investors are moving away from the larger incumbents to newer offerings, split roughly on a 50-50 basis between indexed and the other smaller actively managed funds, which are shown in purple. So the reason the share looks larger here is obviously if we go back to 2015, there was a much higher share that these smaller actively managed balanced funds had of the category overall, whereas the rules-based or index balance funds were pretty much at 0 or 1% at that level. So there's a compounding effect. But if we look at the change in terms of the share of the market, 50% of the flows are going to rules-based or index balance funds away from the largest 10 actively managed balance funds. So this begs the question why we would be seeing that phenomenon over that long period of time. So what this chart shows is at each point, 3 years worth of performance of the category overall splits into the quartile range of returns delivered over that preceding 3 years. So if we look at the last point here, these are the full range of returns on a rolling 3-year basis, for the previous 3 years, split into the different quartiles of returns. And you'll notice there's quite a wide range of returns available amongst balance funds, some losing significant value over 3 years, where you'll see returns for funds being below the 0 line here, which on a 3-year basis for a multi-asset class fund with the diversification available from different asset classes is quite a poor outcome. But amongst the largest 10, which I've shown you an equally weighted blend of with this dotted light blue line, it's obviously been a much safer space to be, as they've avoided those worst performers. So you'll see amongst those largest 10 actively managed balanced funds, they're hardly ever in the bottom quartile, and where they are in the bottom quartile, they're near the top of the bottom quartile. So that's been a much safer space to be. And the reason I show you an equally weighted blend of those largest 10 actively managed balanced funds is that that's actually probably a better benchmark and hurdle and fairer representation, given the size of assets that those funds manage within this category, of what most investors have exposure to in their portfolio. There's a very high probability that you and your clients have exposure to one or more of those largest 10 balanced funds within your portfolio. So I use that as a benchmark proxy for what most investors have experienced as a return experience within their portfolios. And the other point of showing you an equally weighted blend is it highlights the benefits of blending and diversification. Why you don't want to pin your future on the current flavor of the month or the top performer amongst those largest 10 balanced funds, because we find even amongst that stable set, there's quite a lot of variation in terms of which funds are doing well at a given point in time versus those that are lagging. It's quite common to see a fund outperforming and being at the top of these largest 10, only to then be at the bottom and underperforming its peers. So the Satrix Balanced Index Fund is shown in dark blue now, also on a rolling 3-year basis since its inception. And you'll see that its performance has been very stable, with a high degree of consistency above the median of the category overall, and never in the bottom quartile, and always within the range of the largest 10 active funds. It has also provided extended periods of outperformance relative to the largest 10 active funds. So you can see that over here, you can see it over here, and again now the fund is doing extremely well relative to any of the flagship largest 10 actively managed balanced funds that you are likely to have exposure to. So therefore, including our fund into your portfolio would have led to greater peace of mind over an extended period of time while delivering excellent performance. So in fact, we can summarize that consistency of performance on this slide by comparing the performance over the last 7 years of our fund versus all of the other funds in the category. So you'll see that plotted here on the vertical axis from a performance rank perspective relative to the consistency of that performance. So what we've done to measure that is look at the average rolling 3-year rank of all of the funds in the category. And if you rank near the top quartile, you'll then be in this region here. And then we've also looked at the top quartile performers in absolute terms on a 7-year basis. So to define this top quartile from both a performance as well as a consistency of performance perspective. And what's interesting is that our fund scores in that top quartile on both dimensions, along with 3 of the 10 largest active balanced funds. What's interesting, though, is if we look at other rules-based or index balanced funds on the chart on the right, these are shown by the yellow or gold dots. You'll see that over that same period, there are actually only 5 indexed or rules-based balanced funds that have performance for that period. And we see that 4 out of the 5 have also achieved top quartile performance along with our own, versus only 30% of the largest 10 actively managed balanced funds. So this would obviously be one of the reasons why rules-based or index balanced funds have taken market share from the largest 10 active balanced funds, because the performance has certainly supported doing that as an investment decision. But this begs the question, of course, why are these funds more successful? 80% of them are in the top quartile versus only 30% of actively managed funds. Why have they been more successful over this period? So let's have a look at this chart. I've shown you this before, but while compounding has often been said to be one of the 8 wonders of the world in how it can grow wealth, especially over the long term, it can have the effect, the same destructive effect when seemingly small fees are compounded over the long term. So it is therefore unsurprising to actually see this relationship of lower cost funds which are plotted here on, this is the total expense ratio of all of the funds in the high equity category. So lower cost funds tipping the odds in your favor to outperform. So this is their realized returns on a 5-year basis relative to all the other funds in the category. And this line is just a regression line through these funds based on their returns as well as the total expense ratio. So you'll see that lower cost rules-based index funds, which are shown by these yellow dots, as well as the Satrix Balanced Index Fund, tips the odds in your favor to outperform than more expensive funds over the longer term. And this is because of this compounding effect of fees. And to the extent that you can reduce those, you put the odds in your favor to outperforming over the long term. Fees are also particularly important in a low return environment where they will detract a bigger portion of your real return. In other words, your returns in excess of inflation. So important to bear that in mind as well. So the Satrix Balanced Index Fund has achieved top quartile performance over all periods, up to 7 years, which I'm showing you here, outstripping various peer measures over those periods. So whether we look at the largest 10 active blend, which I've shown you on previous charts, or we look at direct competitors such as other rules-based balanced funds, you can see over all those periods, we have outperformed our peers. Returns are shown at the top of this chart, so at the top of each bar, while our funds rank relative to the number of retail funds in the category overall is shown at the bottom of our performance. So, if you multiply our return, our rank by 4, if it's less than the number of funds, that shows you're in the top quartile. So in some cases, we're in the top decile. For example, here, you would multiply that by 10. That would take you to 140 of 100, 149. So that shows you we're in the top decile of funds relative to the category overall. So really outstanding performance that the Satrix Balanced Index Fund has delivered, again, vindicating our investment philosophy of staying the course, sticking to a strategic asset allocation, and making sure that you have exposure to strategic factors, which I'll show you in a moment. Now, over the last 5 years, I'm going to turn my attention to the low equity category for a moment. If we actually see a similar trend within the low equity multi-asset category. The largest 10 active funds have also declined in their share of the overall category from 79% down to 65% now, versus the gain in share of the rules-based index balance funds and other smaller funds. With this particular chart, the take-up of index balance funds has happened later. So again, it's starting on a smaller base, but it does show that with the growing share of index and rules-based balance funds, that these funds are taking market share away from the incumbents, which again shows that the trend of clients adopting indexation in their portfolios is taking place in our market. It's just we're obviously quite a few years behind those global trends, but we expect that to continue playing out in our local market. And the reasons for this shift are similar within the low equity space. I'm showing you this chart over the last 3 years. In fact, that period is interesting because it coincides with when we implemented a number of enhancements to the Satrix Low Equity Balance Fund, specifically including enhanced yield within our cash allocation. We use the SIM Enhanced Yield Fund. We have access to that capability because we're part of the broader group, and that enables us to add a key driver of returns, which are quite important in this low equity space, namely access to credit and other yield enhancing instruments to enhance the cash returns that you get from your interest bearing asset classes, which make up a significant portion of the asset allocation in this fund. It's pleasing to see the effect of those enhancements on our performance, as well as the changes we've made to our strategic asset allocation last year, bearing fruit, namely an increased allocation to interest-bearing instruments given the attractive yields on offer, while reducing the exposure to domestic equity. This obviously bodes well for future stable performance from this fund. Now, the most recent change, as I already mentioned, was in June this year, where we switched to our Satrix Smart Core Index as the domestic equity strategy. So over the last 3 years, we are seeing a similar result as the high equity funds, where a lower cost structure now puts the odds in your favor to outperform. And we see that with other rules-based index funds in this category as well. And with the enhancements we've made to our fund, we've got a great confidence that we'll see the value add being delivered on the equity strategy as we've seen on our Satrix Balanced Index Fund. So the Satrix Low Equity Balanced Index Fund performance has also been very strong over the last year with the recovery we've seen in equity markets. Despite us trimming domestic equity growth exposure in September last year with our SAA review, we're still seeing strong performance pickup coming through from our fund and is ahead of the median and on par with the 10 largest actively managed funds over the longer term. So we're quite pleased to see this result, and we expect this to continue going forward now that we've implemented these various enhancements to this low equity fund. It bodes very well. Now, I've shown the performance of our funds, which stick to a strategic asset allocation only approach and rebalance back to that strategic asset allocation every 6 months. Investors can often be concerned by what they may be missing out on by us not employing tactical asset allocation. It's that very real phenomenon of FOMO, or that fear of missing out. And the past few years have actually offered active managers with a unique opportunity to showcase their value add in using tactical weight allocations to try and drive alpha and value, enhanced returns. This slide in particular shows the rolling 12-month return dispersion over the past 15 years using typical benchmarks to reflect various asset classes' performance. So it shows that the last 3 years have offered historically higher levels of alpha opportunity as defined by higher asset return dispersion. Intuitively, if dispersion was 0, all returns would be similar, right? Thereby rendering active weight allocations useless because it doesn't matter what you'd allocate to, they all behave the same way. But in recent years, the opportunity for alpha has been significant and significantly higher than it has been historically. Now, given this period has coincided with exceptional performance from our fund, which employs no TAA, no tactical asset allocation, either means that large actively managed balanced funds aren't employing tactical asset allocation to any great degree, or they haven't had much success with their tactical asset allocation calls. Now, an interesting side note, our systematic rebalancing back to our strategic asset allocation can actually implement large asset allocation calls, particularly when one asset class runs ahead of the others or significantly lags the rest. These can be tough decisions to buy low and sell high, as sentiment and emotion can easily cloud judgment. But because we run a systematic process, we were able to buy equities and listed property at the lows in March last year when markets were in free fall, as investors grappled with the implications of a global pandemic. Far from missing out, our approach ensures alignment with our stated strategy and will implement the trades necessary. Sometimes those can be large trades to reflect that view. So again, it comes back to sticking to a strategic asset allocation as your primary drivers of return for the long term. Now with that, I'm going to move on to how we harness investment styles and the other key driver of returns in our portfolio. So I've already mentioned and taken you through the slide, and I'm going to focus on this block over here, strategic factors of factor exposures. And I've explained what that is in terms of particularly how an equity manager would have an investment philosophy or style which they adopt in the way that they approach their equity investments. Now, a key way in which our index balance funds differentiate themselves is through our domestic equity strategy. Many of the other rules-based index balance funds do not employ a strategic factor exposure approach or a multi-factor exposure approach within their domestic equity strategy. So this is really the key differentiator of our fund versus many of the other rules-based index balance funds out there. So factors, sometimes also known as smart beta, have shown to be long-term drivers of excess returns globally. And the same is true in our market. I've showcased momentum, value, and quality because we use these three factors in SmartCore, which is our domestic equity strategy, but especially because they have some of the strongest payoffs in our market. And I've shown you this through, over the long term relative to CAP SWIX. In fact, these strategies have delivered between 1.2% to 3.3% per annum in excess of what the market has delivered. But more important than the long-term outperformance, that is very important, but what we must also remember is that they capture unique drivers of excess returns which occur at different times during market cycles. So this chart shows the rolling 1-year relative returns versus the capped SWIX, i.e. the 12-month alphas of Momentum, which is I'm showing you now in dark blue, as well as value and quality indices, which I'll add in a moment. Now, notice how the factors pay off at different times. When Momentum is outperforming, value tends to underperform. So have a look at this over here, Momentum outperforming, value underperforming. But also vice versa. When Momentum is struggling, as it has been doing over the last year, value tends to outperform. And you see the same occurring back here in 2009. And if I add quality to that, it along with the correlations of excess returns of these different indices, you'll see that there's either negative correlation or no, very low correlation in terms of when these different strategies pay off. Sorry, I've mislabeled this. This should say Satrix quality. But there are very few times when two or more factors are underperforming simultaneously, and that's because of what we've observed historically, that these are either negatively or have very low correlations with each other. And typically when one factor underperforms strongly, it is counteracted by strong performance of the others. And this is no different when buying a house. We consider multiple factors when we look to buy a property or an investment property, such as the quality of the property itself, the fixtures and fittings, the momentum of the area. Are there promising prospects for growth? Has there been growth in the area? And whether you're getting that property at a good price for relative to those other features that it offers. And this is exactly what we do in the way that we construct SmartCore. Now, we could construct SmartCore by blending 3 single factor portfolios, as I've shown you the return series of those on the previous charts together, which would create a portfolio blend with exposure to all the stocks captured in the single factor value, the single factor momentum, and single factor quality portfolios. The problem with that approach, though, is that some of these stocks, which I've illustrated in dark gray, while having strong factor exposure to value, may have very negative exposure to momentum or quality. And similarly for the other single factors, you might have a strong momentum stock which is super expensive and has no great quality characteristics associated with it. It could be purely speculative. There's no sound reasons for why it's a momentum stock. So what we do instead is construct SmartCore from the bottom up by assigning aggregate factor scores to each of the stocks in our universe to ensure that the overall portfolio minimizes these offsetting characteristics while maximizing exposure to the desired characteristics that we seek, namely a portfolio which maximizes quality, value, and momentum features. We also control for a variety of risks, including tracking error, sector, and stock exposure relative to a well-diversified parent index, such as capped SWIX, which ensures the portfolio remains well-diversified and best placed to systematically produce alpha. Now, to illustrate why we construct a multi-factor portfolio from the bottom up instead of blending single-factor portfolios together, we need to understand the active factor exposure that each strategy offers. So I'm looking at our momentum index. So this is a single-factor index only targeting momentum. And at the moment, you'll see it does actually have positive exposure to value as well. And this is especially because value is paying off as a factor at the moment. I showed you that earlier in the rolling returns. But at other times, momentum would typically have a negative exposure to value, which would be an offsetting factor exposure to what we actually want in the portfolio. And you can see again, looking at our single factor value index, it also has positive momentum exposure because value is paying off as a style at the moment. Quality, on the other hand, as a single factor index, has strong profitability, which is a measure of quality, but has negative exposure to momentum and value. So if we blend these 3 together, we end up with this factor index blend with positive exposure to momentum and value and a little bit to profitability, but nothing really earth-shattering in terms of moving the needle there. What SmartCore does, by constructing from the bottom up, it raises the factor exposure to all of the key dimensions that we're actually looking for, namely momentum, value, and profitability. So we get enhanced factor exposure. Now, as I've already shown you, factors pay off over the long term. So if you can strategically position yourself to have higher exposure to those factors, you give yourself a better chance of outperforming the index, because those factors do ultimately pay off over the long term. So this comes back to that key driver of return, and why we construct SmartCore the way we do, because it ultimately ensures that we have enhanced factor exposure to factors which reward investors for staying the course and having exposure to them. Now, this is actually quite an interesting chart. See, we are starting to near the end of our time, so I'll take you through this quickly. But our portfolio construction process has a risk budget element to it, where we also constrain turnover in order to keep transaction costs low. But in order to evaluate the quality of the signal, i.e. what we actually use to drive that alpha, we've done what we call an information coefficient exercise to assess the quality of each factor signal through time. So we take out any of the portfolio construction components which drive return. So what this entails is that each rebalancing date since 2005, we construct a similar factor scoring for each stock in our universe as we do today. And then we calculate the rank correlation of the signal and the subsequent quarter's returns for that stock. So what we're testing is whether our signal and the way we score stocks across each dimension of momentum, quality, and value actually predicts returns in the subsequent quarter. Now, if a factor produced a perfect signal, the correlations would at all periods be equal to 1. But obviously, we know when it comes to investing, nothing is ever perfect like that. What we can see with the quality signal is that that signal has actually detracted value over the last year or so, with being quite a negative payoff from the signal in our portfolio. But it has been a strong signal historically through time, delivering on average an information coefficient of 5.8 or 5.8%. For value, the opposite applies. Consistent with what I've shown earlier, value is paying off at the moment, and we see that coming through with the signal more recently, delivering positive outperformance versus our value signal at each quarter end versus the subsequent returns. But historically, as we know, value hasn't been the most profitable investment strategy to invest in. It's gone through a tough period, particularly in our market, and you can see that with the erratic returns being delivered from the value signal, but on average delivering a 5% information coefficient. And then momentum signal generally tends to be strongly pro-cyclical, with periods of relative market calm leading to the signal's high return predictive power. When we combine these signals together, though, we see something interesting happen. So now let's look at SmartCore signal. Notice how the average information coefficient has been increased. We get a much higher information coefficient. And this is as a result of blending those different signals together, like we do in the way we construct SmartCore, which again underscores our conviction of combining multiple factors together. The return dispersion is also interesting, which is shown in this dotted line here. And I'm just going to flick back to the momentum slide. Notice how this high return dispersion, for example, over here and again over here, coincides with momentum going through tough periods of payoff. The dispersion was also high over here and here. So you can see that's coincided with momentum going through tough periods of performance. So again, by combining momentum with quality and value, we avoid those deep drawdowns of only being exposed to one factor such as momentum. So coming back to blending these factors together on a strategic static basis, one ends up with a much smoother and more consistent outperformance experience relative to any one of the single factors alone. And this is shown by our SmartCore returns through time, which on a rolling 12-month basis versus CapSwix, which is the zero line, has outperformed 72.3% of the time, which is a much higher degree of outperformance than you would get from any one of the single factors alone. So it provides that greater peace of mind and comfort that you are able to deliver those excess returns, which our domestic equity strategy sets out to do. And if we look at it, come back to those annualized returns over the long term, you can see how SmartCore has done. It's actually giving you what I call synergy, where the whole is greater than the sum of the parts. If we blended these single factor strategies together, we would expect the returns on a blended basis to be roughly at this level, and perhaps near the value level. But we're getting much higher returns coming through closer to our momentum level overall versus CapSwix. And this talks to the synergy and efficiencies with which we construct SmartCore. I'm also showing you highlighting the 3-year annualized performance of this index. We've been running it with money investing and tracking the strategy for 3 years now. It was first implemented in our Satrix Balanced Index Fund 3 years ago. And you can see what the alpha of this strategy has delivered on a realized basis over that 3-year period. We would expect the information ratio, which is really the alpha divided by the tracking error, to be roughly 0.5. If we're doing worse than that, we'd be disappointed. But we can see we've actually delivered much higher information ratio of 0.83, and over the last year, knocking on the door of an information ratio of 1. So the SmartCore strategy as a multi-factor strategy is working. It has worked on real money in our market, and is really unlocking great efficiencies for clients to be able to systematically access an alpha generating engine. By the way, the Satrix SmartCore Index is also available as a standalone unit trust. So for clients who are constructing portfolios at asset class level, they can access this strategy on a standalone basis as well. And this just again summarizes what I was mentioning earlier, that SmartCore has added significant alpha versus the broad market, the CapSwix. Many of our other rules-based competitor funds only use CapSwix as their domestic equity strategy. SmartCore has delivered alpha in excess of that, is really the secret sauce behind the Satrix Balanced Index Fund. And not only that, it also delivers increased performance versus a single factor blend like I've shown you in the past. And it's because it has that enhanced factor exposure. So that would be the light blue line. So our SmartCore strategy, constructing multi-factor portfolio from the bottom up, delivers outperformance to the broad market, CapSwix, as well as an equally weighted blend of the individual single factors. So we really see it as the best way to approach a multi-factor portfolio construction process. So with that, Gili, I'm going to hand back to you. I've got some 3 key points of why the Satrix Index Balance Fund has an advantage, which is a deep focus on ensuring our strategic asset allocation is optimal. It's a lower cost structure relative to actively managed balanced funds. It also gives it an advantage. And then, very importantly, our focus on harnessing investment styles and factors, which is a primary driver of active returns or alpha. So, Gili, back to you.
Thank you very much, Kingsley. And yeah, thank you. It's a very detailed presentation you took us through. And to our participants, thank you for posting some questions this morning. Kingsley, you've touched on a couple of them. Maybe 1 or 2 that I think you haven't covered in detail is the first question I would like to pose to you is, do you as Satrix utilize any protective strategies inside these 2 balance funds that you manage?
The short answer is no, Gili, we don't. These strategies are not absolute return type funds, which would typically be the types of strategies that would use derivatives and protective strategies to protect performance in a down market. We don't use any protective strategies. These are more beta plays. And we manage the risk profile of these different strategies by focusing on the asset allocation. So you'll notice quite a big difference in the asset allocation between our high equity balanced fund, the Satrix Balanced Index Fund, versus the low equity balanced index fund, which is far more conservative, has much more exposure to interest-bearing asset classes, takes a lot of that equity risk off the table. So we focus on the asset allocation and don't use any derivatives to protect returns.
Right, thanks, Kingsley. And then initially, when SmartCore, you developed SmartCore, you included it into the balance fund, the more aggressive of the 2 balance funds, and almost waited a while before you included it into the low equity balance fund. What was your thinking around that, or what was the rationale for that?
Yeah, I think a lot of it stems from the fact that the low equity balanced index fund is a fund designed for more conservative and risk-averse investors. So we wanted to make sure that Smart Core works in practice before introducing it into a more conservatively managed fund. I mean, the proof's in the pudding in terms of what I've shown you today. Smart Core has been delivering exceptional returns above the market. So we're very pleased with the outcome. You know, all of the back testing and research that we've done over the years that has culminated in us creating the Smart Core strategy has proved to work and in fact exceed our expectations in terms of what our long-term expectations of what it would likely deliver. So we have great confidence in now introducing it into a more conservative fund, because ultimately it does offer an additional return driver there by delivering excess returns relative to the broader market.
Yeah, and I actually can add to that as well as Kingsley. I mean, when we initially launched Smart Core, a lot of our clients asked, how can I utilize it as an equity building block? And then we made it available, as a unit trust, as a standalone equity product. And the take-up has been surprisingly good. So I also think for our clients that utilize building block approaches or wants to allocate to specific equity components that could enhance the outcomes together with combining with active managed funds, I think Smart Core is a very good proposition to include in your equity building blocks.
Yeah, I mean, that fund is now sitting at about 2.4 billion in AUM. We've had great support from clients externally as well as internally. So that's very pleasing to see, and it makes sure that fund is large enough to take material flows from other investors who are concerned about fund size.
Yeah, and Kingsley, I mean, Satrix, a very exciting brand for people that's been following the brand for the last couple of years, moving, initially from the vanilla indices into smart beta factors and now into the balanced fund space. I also think you've got some very interesting news to share with regards to the CAPI that you launched yesterday. Can you give us, our listeners, an idea of what is the CAPI index to start off with?
Yeah, sure. So it's the capped all share index, and we're going to be launching that as an exchange traded fund. That is quite an interesting development in itself, because if you look on the JSE, all of the ETFs on the JSE only provide exposure to a segment of the market, typically the top 40, maybe mid caps, or otherwise a sector of the market. They tend to be quite concentrated portfolios. There hasn't been an ETF on our local on our local JSE market that offers exposure to the entire JSE. So this is the first time an ETF is coming to market which is offering that. We're also launching it at a zero fee for till the beginning of June. So that's 6 or 7 months when it starts trading in November. That'll be at a zero fee, so no TER until the 1st of June. So that's an exciting development, really, to encourage clients to invest in our local market, and to, as an acknowledgement that Satrix is at the forefront of leading the indexation charge and offering value to our clients. If I can maybe just share, Gili, what the CAPI offers as an investment strategy. Hopefully that's coming through on your side, but these are the rolling 3-year returns of the ASISA general equity category. The 0 line represents the median performance, and then the darker shaded area represents the top quartile and bottom quartile range of returns, and the light shaded blue represents the top decile and bottom decile range of returns that have been delivered by general equity unit trust funds. And what we've done is we've overlaid the CAPI relative to the median, and relative to obviously these other returns as well. We've deducted 30 bips of fees. So just to explain that CAPI ETF will have a 25 bip TER. So once the fees kick in June next year, it'll be a 25 bip TER. Because it's an ETF, the transaction cost should remain low, hopefully less than 5 basis points. So we expect on a TIC basis that total investment charge for the CAPI ETF to be no more than 30 bips. So we've deducted 30 bips off of the CAPI index so that we can compare like with like relative to net of fee retail unit trusts. And you can see the high consistency of outperformance that the Cappy has delivered relative to peers in the market. And a lot of this has come from its high offshore exposure. The Cappy has high offshore exposure, as well as not having excess concentration in any one stock. It's a well-diversified portfolio. So it gives clients broad exposure in a very well-diversified way. And it has served clients, clients tracking an index, even on an after-cost basis. It gives them a great degree of success of delivering above average performance, very much consistent with the arithmetic of active management. So as I've shown in some of my other presentations. So we're very excited about bringing this to the product, to the JSE, and giving clients the ability to get broad market exposure with the purchase of a single ETF.
Yeah, and I know we're running out of time and we can probably explore this further, Kingsley, but the only thing I want to add to our participants, it's also, it's zero fees up until June next year, but regardless of the platform or the mechanism that you actually access it. So whether you buy it via your stockbroker, via a list platform where it might be listed, or directly, it's irrelevant. So we're not channeling the flows into our specific platforms where we actually make money out of the rest of the value chain. It's a true zero cost regardless of the access point. So you can feel free to allocate your clients money to that, and you can know that it will be a zero cost impact up until June next year, regardless of the platforms. So Kingsley, we're running out of time. Thank you very much, as always, for a very detailed feedback session. We really appreciate it. I enjoyed it. I hope our participants have. And to our participants, thank you very much for choosing to share time with us this morning. But before we go, please keep an eye out for our invitation with regards to our final SIM webinar towards the end of the year. And yes, you've heard me correctly, final SIM webinar, not webinars. Everybody, I think, is kind of struggling with Zoom fatigue or webinar fatigue. So we're going to have one session. We're changing it up a bit for the last quarter. It's going to be a live broadcast out of Cape Town. We're very excited about it. During that session, you will get exposure to our Chief Executive, Nersa Naidu. He's going to give you our view of how we see the industry, where we see it going, and how we are as a business well positioned to follow those trends and lead in certain of these trends, we believe. And then also Arthur Camp is going to give you not an economic overview, but an economic outlook, more specifically towards 2022. The drivers of economic drivers you can look out for that's going to be relevant to client portfolios. And then lastly, I'm going to host a panel discussion with all our active managed or managers, portfolio managers. So we're looking forward to a very interesting debate down to asset class level on how these portfolio managers sometimes see the world in a similar fashion, sometimes a bit different, and also how they execute it within their specific mandates. So once again, it would be really exciting if you guys can join us. I know it's at the end of the year, but we're really doing our best to put in our best effort to make it an exciting production. So up until then, once again, thank you for your time, and hope to see you at that webinar towards the end of the year. Goodbye and enjoy the rest of your day.